really can't tell often what the trend is. So that's a very good response there. Now, you have to remember that even though you set your initial trend rating at a high 6+ or more, that you not all trending patterns will have this high initial trend reading. So again, if you set it too high, you may not get the amount of trade opportunities that you're looking for. So again, personal preference is going to be the guide there. If you want to, sometimes some of the best patterns come out of low initial trend readings. So I'm just suggesting that the 6 or higher is a good place to start. If you find that it's not enough to suit your trading capability, then by all means set the parameters a little bit lower. You also remember that when you do start to take trades that have low initial trend readings, that you may not get a strong trend at all, that it may turn out to be weak. That's why I suggest when you work with initial trends to try to pair it up with strong breakouts. So you want those two to work together. You want to have a good initial trend reading, and you want to have a very good breakout reading, because they tend to work together. Always remember that the trend is your friend. Okay, that expression's been tossed around for hundreds of years in the marketplace. You hear it a lot in Chicago here when you're working with traders when they're asking for recommendations and for direction. The easiest thing to default to is the trend. Okay, now knowing that the trend is your friend, you always have the opportunity to buy strength or to sell weakness, which a lot of traders don't want to do. They can have a fear of paying too much for something or selling something in the hole. You know, they don't want to do that. So some of them prefer to identify the trend and then wait for a pullback. You know, so they're waiting for the market to come back. And the funny thing about it is that each style of trading, whether you're buying strength or selling weakness, or whether you're buying support or selling resistance, each one of them could be successful at different times. But what happens is your trading profile, your trading statistics look a little bit different. For example, a trader that buys strength is known as a momentum trader. If you're day trading the market and you see a breakout occurring on an Autochartist, say 15-minute chart, then the day trader tends to want to take out offers. Okay, he wants to take that offer out and try to see if he can produce a quick move to the upside or a breakout, or we like to call them momentum or volatility type traders. That's how the majority of day traders trade. They want that quick surge, and when the market does begin to weaken or that momentum slows down, then they have a quick out and they exit pretty fast. All right, now the trader that likes to identify the trend and buy dips in the marketplace, he's the type of trader that wants to have control over his price. So he's not willing to pay up. He's not willing to take out an offer. Traders that take out offers or buy strength, they run the risk of paying up or getting slippage in the market. All right, and the trade-off there is that they're in the market. If it's a good market and it's going to rally and there's volume behind it and there's volatility, they're not going to miss the move. So they're willing to forego that slippage, and they're looking for this market to continue up. That's their personal preference. Now, the trader that buys support in an uptrend, he runs the risk that the market's not going to pull back into his price zone. So he is the one that's willing to sacrifice being in the market for getting the price that he wants. So whenever you watch these Autochartist setups, you're going to see breakouts at times, all right? And some of the patterns, for example, the non-trending patterns like triangles, they tend to be clean breakouts with high momentum, and I'll show that in a minute why that works. And then channel trades tend to be the kind that break out and then pull back a little bit. And I'll explain that too when I show you some live data. But basically it comes down to the distance between support and resistance. The wider the market is at the time it's breaking out, then the tendency is for it to pull back. And the tighter the support and resistance is, the greater the tendency for a breakout. And that's the way traders operate. Traders like to see that the market is compressing. They like to see the sideways action taking place, and then they like to trade the breakouts. Believe it or not, traders get uncomfortable when a market trades the same price level over and over and over, and that gets to be pretty boring. They like to see change in the marketplace, and that's why breakouts work very well, and that's why Autochartist is a successful trading program, because it identifies these breakouts that other traders or big money institutions like to follow. So that's really the main point. But the idea is that when you see that the trend is your friend, you can either be number one, be a guy who is going to trade exactly when the trend turns on the breakout, or you can be one that allows the market to change trend and then try to buy a pullback. That's the kind of thinking that you have to do, and that has to be part of your trading plan. You have to determine whether you are a pure trend trader, a pure momentum trader, or if you're the type of trader who likes to let the market go up and then try to buy dips in it. And it makes a big difference in your trading statistics. All right, now the same strategy can be applied for downtrending markets. Okay, as a trader, a short-term momentum trader, you may want to be a person that hits the bid, okay, and tries to drive the buyers out of the marketplace. Okay, those types of traders look for momentum to the downside. At the same time, another group of traders may say that once the trend is identified as down, they want to sell retracements back up. And the same risk-reward parameters work there. The person who trades for momentum and wants to hit a bid, he's the one that runs the risk of slippage, whereas the trader who wants to wait for the trend to change and then sell rallies, he's the one that is comfortable with waiting for the market to come back to him. Okay, that's the trader that is worried about getting filled at a precise price, but he also runs the risk of missing the move. Okay, those are the trade-offs in the market, and that's really the key. Is that these markets always have trade-offs. That affect your risk-reward. So those are two things that you have to decide when you're trading these patterns, trending and non-trending, whether you're willing to pay up to get in or if you're willing to wait to get in. Okay, that's very, very important point. Okay, as I said before, personal preference is going to help you decide what type of trader you are. If you're the kind of trader who gets analysis paralysis, who gets a little bit nervous about slippage and paying up for a price, he's the one that's maybe going to be willing to wait back and wait for that market to come to him. Okay, now that's the type of trader that says that he has identified an area that the market is likely to stop at. Okay, and at the same time, when a trader puts a bid in the order, in this order to wait for a pullback, he's also telling the market, he's saying, hey, I think that my order can stop the market. Okay, you think about it, when a market's going up and you're putting in an order to wait for a pullback, you're saying to the market, okay, I think this market's great, it's going up, but you know what, for a few minutes I want to see it come back, fill me, and then take off again. So those types of traders tend to be the ones that really sometimes ask the market to do too much for them. Also remember that when you put in a bid, you're basically saying, all right, I'm big enough to stop the market. Or what happens when you put in a bid on a market, you're also running the risk that the market's going to go through your price and continue lower. That's why professional traders prefer to see markets stabilize, trade sideways. Yes.
Hi, sorry to interrupt you. I was wondering if it would be possible for us to maybe move over to some live action right now. We've got quite a few people wanting to see Autochartist in action. So if you could maybe work that in, that'll be great.
Yeah, I was going to work into the non-trending patterns right now, and I'll do that right now. Okay.
Thanks so much.
Sure, no problem. What I've done here is I've set up the market for a number of searches, okay, in my FX trending patterns. You can see, I'll show you really quick on my edits. What I've done here is I've gone through my patterns and I've showed that I'm looking for bull-bear patterns. I'm looking for continuation and reversal. But what I've done here is I have selected only trending patterns: channel down, channel up, falling wedge, rising wedge patterns, as well as the flag pattern. Okay. Now when I go into that search for trending patterns, this is what Autochartist has given me this morning. There's a US dollar, Canadian dollar. It's a rising wedge pattern. Okay. So you can see that this is a rising wedge pattern. It's got the characteristics of a channel and a triangle. And what it's doing here is it's broke through the resistance line, and now Autochartist is signaling that it's got an opportunity to drop into this forecast zone identified at 102.99 or 103.69 to 102.99. So here's where I've prearranged my searches. You can see I've got Autochartist has filtered out all the other trade patterns, and it's looking for only trending patterns, and that's rising and falling wedges, channel down, and here's a channel up. So there's all kinds of different searches here, but they're all trending searches. You can see here that with my initial search, I have a 7 initial trend, which is a little bit better than that 6-bar initial trend, and I have a 10-bar maximum breakout. All right, you can see that I have pretty solid initial trend and a pretty solid breakout, and those types of moves tend to be greater moves than if we had a weak initial trend, for example, and a weak breakout. So you can see how the initial trend and the breakout work together. Okay, the other thing is, notice that as the wedge develops, you get compression in the marketplace. Okay, and although this is still a little bit wide by my standards, once the market broke through there, you want to see some follow through to hit this area here. All right, now this pattern here, as I was saying before, when this is wide or there's been a steep decline into this breakout, you tend to get the market to linger around this resistance line before the trend develops. Okay. Now here is this is based on a 92 bar length pattern on a 15-minute chart. Okay, with a 15-minute chart, you want to see that you have high length, a high length. So here's the 15-minute off of 148 bars. It's the same pattern. It's a rising wedge, but it began at a different point. Okay, you can see that this started out a little bit longer and that the market began to break out. But again, with the wedge pattern, a trending pattern, you tend to sometimes get it to follow through, and then it sometimes retraces in here. That's when I was saying you have to decide whether you want to be a momentum trader and be willing to trade for the momentum down, but be willing to exit if it reverses. The counter trend trader is the one that wants to trade after a breakout and a retrace and then back down. Okay, now here's a pattern in the euro US dollar. This came up earlier this morning. This is a channel down pattern. Let's take a look at what this completed pattern did. Okay, we had here, we could see that it had a very small target area on the breakout. Okay, that just touched the target, and after that the pattern failed, so it resumed its downtrend inside the channel. Now what we have here is on this side, these are emerging trending patterns. These are patterns that are still trading inside of the support resistance lines that haven't really confirmed yet. Okay, this was one that was trading inside of a rising wedge, and then finally it started to break down. This is a pattern from earlier this morning also. Okay, if we go through more of our searches here, you can see that if you control the filtering, you can be a type of trader that can look at both rising and falling wedge patterns. Okay, now we also have the ability to set up our trending patterns for search for the stock indices. Okay, these are the global CFD markets. All right, so this Italian or Italy 40 market here, this is the CFD representing the stocks of Italy. This morning this just came up on a 30-minute search, and we had a channel up at that time. Okay, you can see with the channel, these aren't quite parallel lines, but you can